I think it is increasingly difficult to hedge against what we think is a higher than average risk of near-term volatility in markets. We think the markets have perhaps over the near term run a little too fast, but with interest rates now near the zero bound, correlation between assets are increasing, and it is more and more difficult for investors to effectively diversify. Now, we think that investors can explore positions in some hedging positions that are still fairly effective, such as gold, developed market investment grade bonds, and also defensive currencies such as the Japanese yen, and also potentially pairs such as the US dollar versus EMFX. And I think more than ever, given that, frankly, the pace of the market has been a little bit fast and furious over the last couple of months, it is important for investors to build in these hedging positions.
Well, talking of fast and furious, I want to get your view on the surge in mainland Chinese equities we saw yesterday. What did you make of that? And on the rationale that we were hearing from a state news, that the wealth effect of the capital markets, this statement may have encouraged that rally, and the prospect for a healthy bull market in China. Was that enough to drive what we saw yesterday?
The Chinese market is, to a larger degree, driven by retail investors than in developed markets. So the fact that we saw state media sanctioned, in a sense, a bull rally, I think prompted a lot of this optimism, together with optimism over the reopening, over the fact that there's still a lot of confidence in policymakers in delivering stimulus, and also the fear of missing out. Now, a lot of institutional investors have been skeptics and really are increasingly throwing in the towel over the last few weeks. So all these are driving these gains in the Chinese market. But, you know, we have seen this movie before, and there is no free lunch after all. So over the long term, the market will return to fundamentals. And we think that there are still risks in the backdrop that demands attention, such as the risk of second waves of infection. And not to forget, the US election is coming up. President Trump is slipping in the polls, and the risk of a rollback of his tax cuts could be a headwind for the markets as well.